Every trader has a system: entry rules, exit rules, risk parameters, a defined edge. Most traders follow that system perfectly, right up until the moment nothing is happening. Because the hardest trade to manage is not the losing one. It is the one you were never supposed to take. The one born from silence, from stillness, from the unbearable feeling that the market is moving and you are not in it. That feeling, that quiet, persistent discomfort of doing nothing, is responsible for more account damage than bad strategy, bad entries, or bad timing combined. It does not announce itself. It does not feel like a mistake. It feels like initiative. It feels like engagement. It feels like you are doing your job. But underneath that feeling is something the market will expose eventually. You are not trading opportunity. You are trading discomfort. And discomfort is the most expensive thing you can trade. Let's go deep on this, because understanding why you overtrade, truly understanding it at the neurological and psychological root, is the only thing that will stop it. Part 1. The discomfort of inactivity. Let's begin with something simple. Most traders are uncomfortable doing nothing. Flat position, charts open, market moving, no trade. That state creates tension. You feel like you should be involved. You feel like you are missing something. You feel like opportunities are slipping past you. But here's what you need to understand. That feeling is not market-driven. It is not a signal from price. It is not your edge speaking. It is psychological discomfort. And many traders, most traders, trade simply to eliminate that discomfort. Let's walk through a scenario. You have been watching the market for 2 hours. Nothing clean has formed. Your plan says wait. The criteria are not met. The structure is not there. But price starts moving. Not clean, not structured, just moving. And you begin to feel it, that pull, that urgency rising in your chest. If I don't enter now, I'll miss it. Price is moving. I should be in this. I've been watching for 2 hours. Something has to happen. So you take the trade. A marginal setup, below your stated criteria, but you take it. It moves slightly in your favor. You feel validated. You think, I knew it. But what just happened? You did not identify an edge. You lowered your standards to escape boredom. That is overtrading. And it rarely announces itself that clearly. Most of the time, it is quieter, more subtle, a slightly early entry, a setup that is almost there. A trade taken because the chart is open and the market is moving, and doing nothing feels worse than doing something. That reflex, quiet, habitual, invisible, is the root of the problem. Part 2. The neuroscience. Dopamine and the trading brain. Let's go inside the brain, because overtrading is not just a discipline problem, it's a neurological one, and understanding the mechanism changes how you address it. Every trade produces stimulation. Win or loss, profit or drawdown. The moment you click, the moment you enter a position, your brain releases dopamine. Not because you made money, because you acted. Action itself is neurologically rewarding. This is fundamental to how the brain works. The dopamine system is not a reward system in the simple sense, it's an anticipation system. Dopamine fires in response to the possibility of reward, not the reward itself. The click, the entry, the open position, the watching of price move, these are all dopamine events. And here's where it becomes dangerous for traders. The brain does not distinguish between a high-quality trade and a low-quality one. Both produce stimulation. Both release dopamine. Both feel engaging. Over time, your brain begins associating being in a trade with feeling alive, and being flat, sitting still, doing nothing, waiting, begins to feel like deprivation, not strategically, biologically. Your nervous system has been conditioned to seek the stimulation of activity, and it will generate compelling reasons to act. This setup is close enough. The momentum looks right. I've been watching this level for an hour. These are not analytical conclusions. They are rationalizations generated by a brain seeking its next dopamine hit. There's also a second neurological layer: variable reward conditioning. This is the same mechanism that makes gambling addictive. When rewards are unpredictable, sometimes you win, sometimes you lose, the dopamine response actually intensifies. Unpredictability makes the brain more engaged, not less. And trading is the ultimate variable reward environment. Every trade has an uncertain outcome. Every click might produce a win. That uncertainty keeps the dopamine system highly active, which means every time you sit still and do nothing, you are fighting not just boredom, you are fighting a conditioned neurological response that has associated action with stimulation. This is why telling yourself to be patient is not enough. Willpower alone cannot override a conditioned dopamine response. You need structure. You need rules that operate before the urge can build. Because once the urge is present, the brain is already partially hijacked. The intervention has to come earlier, before the chart is open, before the session begins, in the planning stage, when the prefrontal cortex is fully online and the dopamine system is quiet. That's when you set the rules, and the rules protect you when the dopamine system activates. Overtrading feels like effort. This is one of its most effective disguises. You are watching charts, you are analyzing constantly, you are entering positions, you are managing trades, you feel busy, you feel like you are working, you feel like you are serious about this. But busyness is not the same as profitability. And in probabilistic systems, overexposure does not increase edge, it dilutes it. Here is a simple way to think about it. Imagine you have a strategy with a genuine 55% win rate on qualified setups. Over 100 qualified trades, that edge produces consistent, positive expectancy. Now imagine you also take 50 additional marginal setups that are close but not fully aligned. Those marginal setups might have a win rate closer to 45%. What happens to your overall results? Your average win rate across all trades drops. Your transaction costs increase. Your mental bandwidth is consumed managing positions that should never have been opened. Your emotional state deteriorates from the additional losses. And your performance on the qualified setups suffers because you are tired, frustrated, and distracted. Overtrading does not just add bad trades to your record, it degrades the good ones, because trading is a performance activity, and performance requires resources, mental clarity, emotional stability, physical energy. Every marginal trade consumes those resources. Every unnecessary click depletes the reservoir. And when the genuinely high-quality setup arrives, the one your system was built to capture, you meet it depleted. Half your attention on the marginal position still open, half your confidence eroded by the unnecessary loss from an hour ago. The best opportunity of the session finds you at your worst. That is the hidden cost of overtrading, not just the bad trades, the way the bad trades corrupt the good ones. Part 4. The subtle shift in standards. Here is what makes overtrading so difficult to catch in yourself. It does not feel like recklessness, it feels like flexibility. Under neutral conditions, you have criteria. You wait for trend confirmation, you wait for structure, you wait for the confluences that define your edge. But after sitting idle for an extended period, something shifts. The criteria remain the same on paper, but your interpretation of them loosens. Trend confirmation is mostly there. The structure is close enough. Volume isn't ideal, but the level is right. One small compromise, then another, then a third. Each one individually feels reasonable. Collectively, they represent a complete abandonment of your edge. And this is the insidious nature of the shift, because you never feel like you changed your rules. You feel like you are applying judgment, adapting to market conditions, being a sophisticated trader rather than a rigid one. But there's a critical difference between adaptive judgment and lowered standards. Adaptive judgment means recognizing when market conditions have genuinely changed and adjusting your approach accordingly. Lowered standards means redefining what qualifies because waiting has become intolerable. One is strategic, the other is emotional. And the more hours you spend watching charts without trading, the harder it becomes to tell the difference, because your brain, seeking stimulation, conditioned by dopamine, uncomfortable with stillness, will present every compromise as wisdom. It will make the marginal setup look compelling. It will generate narrative around the noise. It will tell you this is the right trade, and it will feel true, because the brain is very good at believing what it wants to believe. Part 5. Fear of missing out. Overtrading is often fueled by fear, not the fear of losing, the fear of not being there, the fear that the one significant move, the one that would have made the week, made the month, will happen without you. So you enter early, you enter often, you enter preemptively, just in case. But here's the mathematical reality. Entering more frequently does not increase your participation in major moves. It increases your exposure to noise, and noise erodes capital in a way that is deeply demoralizing. Not through one large loss, through dozens of small ones, small commissions, small spreads, small losses on marginal setups, each one individually insignificant, collectively a slow bleed, a capital base that never quite recovers, a drawdown that never quite clears, a performance that is always slightly below where it should be. And underneath it all, the fear remains, because fear-driven overtrading never resolves the fear, it feeds it. The more you trade out of fear of missing out, the more losses you accumulate. The more losses you accumulate, the more you need to recover. The more you need to recover, the urgency you feel to be in every move. The loop closes on itself, and the only exit from the loop is changing the underlying belief that drives it. The belief that being in the market equals participating in opportunity. It doesn't. Being in the right trade at the right time equals participating in opportunity. Everything else is just exposure. Part 6. Lessons from professional traders. Some of the most instructive wisdom about overtrading comes not from textbooks, but from the behavior of professionals who have navigated markets through decades of volatility. One principle observed consistently across experienced traders is this: the quality of a trading day is not measured by the number of trades taken. It is measured by how faithfully the process was executed. A professional can have a session with 0 trades and consider it a success, because 0 trades, when 0 setups qualified, means the process worked perfectly. The discipline to not trade is treated with the same respect as the discipline to execute a trade. Another widely shared principle among experienced professionals: your edge exists in a narrow band of conditions. Outside those conditions, you have no edge. And trading without edge is not neutral. It is negative expectancy, because markets have friction, spreads, commissions, slippage. Every trade costs something before price moves a single tick. A trader with no edge who trades frequently is guaranteed to lose. Not probably, guaranteed. This mathematical reality is what professionals internalize deeply. They understand that every trade taken outside of their defined conditions is not just a neutral event, it is a donation to the market, a voluntary transfer of capital from their account to someone else's. There is also a behavioral pattern observed in the most consistent professionals. They describe inactivity not as something they tolerate, but as something they value. They have reframed stillness, not as the absence of trading, as the preservation of edge. They are not doing nothing. They are protecting their capital from suboptimal deployment. They are maintaining their mental resources for high-quality opportunities. They are operating the business of trading with the same discipline a serious investor applies to capital allocation. Not every opportunity deserves capital. Most do not. And the professionals who understand this, who have internalized it at the identity level, trade far less than amateurs and outperform them consistently. Part 7. The mathematical impact. Let's quantify the damage precisely. Assume your strategy performs at its best in high-probability setups. In a typical week, 5 to 7 of these qualify. You take all 5 to 7. Your expectancy is positive. Your equity curve trends upward. Now introduce overtrading. You take those same 5 to 7 qualified setups, but you also take an additional 15 marginal trades throughout the week. What happens? First, your transaction costs increase significantly. 20 to 22 trades instead of 5 to 7 means 3 to 4 times the commissions and spread costs. Second, your win rate across all trades decreases. Your qualified setups might win at 60%. Your marginal setups might win at 40%. The blended rate is worse than either in isolation. Third, your mental bandwidth is consumed. Managing 20 open and closed positions per week is cognitively exhausting. By Thursday, your analysis on the genuine setups is shallower, your patience is thinner, your execution is less precise. Fourth, your emotional state is compromised. The additional losses from marginal trades create frustration. Frustration creates urgency. Urgency creates more marginal trades. And fifth, the compounding effect. Drawdowns from marginal trades delay recovery from normal losing periods. What should be a 1-week drawdown becomes a 3-week drawdown because instead of stopping the bleeding when qualified setups return, you are still recovering from the unnecessary losses. The numbers do not lie. Frequency without selectivity is not a strategy. It is self-sabotage wearing the disguise of hard work. Part 8. Identity and the selective operator. Some traders equate identity with activity. If I'm not trading, I'm not working. If I'm not in the market, I'm falling behind. If I'm not taking trades, I'm not improving. This identity, the active trader, the always engaged market participant, feels professional. It feels serious. It feels like dedication. But it is a trap because it ties your sense of competence to the number of trades you take. And when that's the measure of competence, stillness becomes a threat. Every quiet session feels like failure. Every day without trades feels wasted. And so you manufacture trades to feel competent. You click to feel like a trader, not because your edge is present, because your identity demands activity. The shift required here is fundamental. You must move from identifying as an active trader to identifying as a selective operator. A selective operator is not defined by how much they trade. They are defined by how well they protect their edge. Their patience is not weakness, it is precision. Their inactivity is not passivity, it is strategic restraint. The selective operator understands that the market will always produce more setups tomorrow, that missing one opportunity today costs nothing, that taking a bad trade today costs something real: capital, confidence, clarity. When your identity is built around selectivity rather than activity, the psychological landscape of trading changes entirely. Quiet sessions feel like discipline. Days without trades feel like professional execution. The discomfort of inactivity loses its grip because you are no longer measuring yourself by action. You are measuring yourself by process. And process, consistent, disciplined, selective, is the only measure that leads to long-term growth. Let's get concrete. Because understanding the psychology of overtrading is only useful if it changes behavior. And behavior change requires structure. The first tool is the pre-session criteria checklist. Before the session begins, Before charts open, before price moves, before the dopamine system activates, write down your exact criteria for the day. Not general criteria, specific ones. What structure do you need to see? What confirmation is required? What is your maximum number of trades for the session? At what point will you stop for the day regardless of what the market does? This checklist becomes your contract with yourself, written in a calm state, before urgency arrives, when the prefrontal cortex is fully operational, and when the session produces no qualifying setups, you close the platform. Because the session was a success. The process worked. The second tool is the entry question. Before every single trade, without exception, ask out loud, does this fully meet every criterion on my checklist? Not mostly, not partially, fully. If the answer is anything other than yes, you do not trade. This single question, applied consistently, eliminates the majority of marginal trades. Because the marginal trades cannot survive honest scrutiny. They rely on the fast, impulsive part of the brain. They dissolve when the slow, rational part is engaged. The question engages the rational part. The third tool is the stimulation audit. At the end of each session, review every trade taken. For each one, ask, did I take this because the setup was fully qualified? Or did I take this because I needed to do something? Your honest answers over time will reveal the proportion of your trades driven by edge versus discomfort. That proportion is your overtrading index. Watch it decrease over weeks and months as awareness builds. The fourth tool is the structured break protocol. After any marginal trade, a trade you took that you knew was below your standards, close the platform for 30 minutes, not as punishment, as a pattern interrupt. The 30-minute break breaks the momentum of the overtrading cycle. It resets the nervous system. It restores objectivity. And it creates a physical consequence for compromised execution, which makes the behavior less likely to repeat. Structure reduces impulse. Impulse thrives in unstructured time. Build the structure before the session. Let it carry you through it. Part 10. The core shift. Stop asking, what can I trade? Start asking, what deserves capital? These are not the same question. The first question assumes trading is the default. The second question treats trading as something that must be earned by the setup. Capital is finite. Attention is finite. Mental energy is finite. Every trade you take is a deployment of all three, and deployment without justification is waste, not neutral, waste. The traders who build consistent equity curves are not the ones who find the most trades. They are the ones who find the right ones, and then have the discipline to wait for them, even when the market is moving, even when the charts are open, even when doing nothing feels like falling behind, especially then. Because that moment, the moment when inactivity feels intolerable, is exactly when your edge is most at risk, and protecting your edge in that moment is the most important trade you never take. Selective deployment is strength. Excessive deployment is insecurity. Overtrading is fear disguised as productivity, and fear is expensive. Look at your last week of trading honestly. How many trades fully met your highest criteria? How many were taken to relieve boredom? How many were taken because the market was moving and you were not in it? How many were taken because doing nothing felt worse than doing something? Your answers are not a judgment. They are a starting point, because awareness precedes change, and change, real, durable, compounding change, begins the moment you see the pattern clearly. The traders who endure in this profession are not the most active ones. They are the most selective. They have learned to sit with the discomfort of inactivity without acting on it. They have rewired their relationship with stillness, not into passivity, into precision. The market will always present more setups tomorrow. Missed opportunities cost nothing. Bad trades cost something real. Never forget which direction that asymmetry runs. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video. Until then, control your mind.